One of the biggest lies told about Nigeria is that it's a rich country. People who propagate this inaccuracy assume that an abundance of natural resources equates to national wealth, when in fact, it could lead to what economists describe as the Dutch disease. That is, the decline of other vital sectors such as manufacturing and agriculture. This indeed is what has befallen Nigeria. One economic metric that encapsulates all that is wrong with the Nigerian economy is the GDP. Last week, the Nigeria Bureau of Statistics released the current GDP figure for the second quarter of 2024, and it came to 3.19%, higher than 2.98% recorded in the first quarter of 2024. Now, is this something to be happy about? How should you account for this when you make investment decisions? Also last week, the company that many dub the godfather of artificial intelligence, NVIDIA, released its second quarter report. That report beat expectations in terms of earnings per share and revenue. In fact, revenue grew by 122% year on year. Yet, the stock price for NVIDIA went down by 6% last week. Why? Why was the market not satisfied with this spectacular performance by NVIDIA? This and many more on the 6th episode of Market Tip. Let's go. Good morning, happy new month, and welcome to a brand new episode of Market Tape. I am Nathan Casey Mokoro. This is a reminder that if you're looking to stay up to date with insights and analysis from the Nigerian and global capital market, you need to be on this show every Monday as we drop it. The insights from this show can also be used to enhance the performance of your portfolio if you never miss any episode. So I encourage you to subscribe and hit the notification button so that you never get to miss any of my shows. Now, as a disclaimer, nothing said on this show should be construed as an investment advice or solicitation to purchase or invest in any security. Investing comes with a high level of risk or with various degrees of risk, and you want to be sure that you are accounting for those risks as you make your investment decision. Nothing said on this show has considered your individual situation and risk profile. So you need to be speaking with an expert before you put whatever information you receive on this show to your personal use. Also note that I may hold investment positions in some of the securities discussed on this show. For details of investment positions that I or member of my teams hold, go to the description button of our various channels to get information on those. This will allow you evaluate the objectivity of what I say on this show. Now to the business of the day, GDP, and why does it matter? Whether it's government, individuals, businessmen, investors, everyone frets so much about gross domestic product, GDP. What is really GDP, and why should anyone care about it? GDP is, by definition, is the total value of final goods and services produced in a country in a specific period of time. So in a way, it kind of measures the overall output of any country or an economy. You can equate GDP to the wealth of an individual, the wealth of a family. How much is this individual making in a year? That is what GDP kind of measures at the national level. So it kind of tells you the economic health of the country and the well-being of that country. So GDP is a very important metric that governments look at every time to evaluate whether the economy is growing, whether it's moving in the right direction or not. So every time this number comes out, there's always some sort of excitement or panic or disappointment, depending on what number you are saying. So for Nigeria, we've had a GDP that has been growing from 1960 to date. In 1960, the Nigerian GDP, which is, as I defined earlier on, the value of final goods and services produced in Nigeria. So if you put together what the companies working in Nigeria, whether it's manufacturing, mining, agricultural concerns, services like banking services, telecommunication services, if you put all that together, I mean, in 1960, we didn't have telecommunication services then, but whatever you can classify as services like banking, in those days, insurance, and those type of things, came to $4.2 billion in 1960. The highest we've seen in terms of GDP for Nigeria was $574 billion in 2014. Currently, as at the end of 2023, Nigeria GDP came up to $363 billion. So in a way, you can say the GDP has been growing. It's gone from $4.2 billion in 1960 to $363 billion today. As of the end of 2023, we stood at $263 billion. So one can argue that the GDP has been growing. But the question would be, if we assume that the Nigerian GDP has been growing, why then do we have unemployment, hardship? At some point, we had a report that said Nigeria was the world's poverty capital. How can a country with growing GDP be also classified as a country where there's so much hardship? We're facing all sorts of issues in Nigeria: banditry, terrorism, high level of inflation, civil unrest, and all of these things. So how come we have these issues when our GDP can be said to have been growing over the years, despite the decline from 2014 to date? Within this period, they went down from $574 billion to $363 billion. Now, there's another metric that is important if you are looking at GDP, because you can't simply compare the GDP of Nigeria to that of South Africa, because these two countries have different population, different sizes. You can compare, again, Nigeria to a small country like Rwanda, because obviously the bigger country should have a larger size of productivity. So the only way you can compare GDP across countries is using a metric called GDP per capita. GDP per capita simply means taking the output of a country and dividing it by the number of people who live in that country. So if you look at this particular metric, you can now compare countries irrespective of their sizes. For Nigeria, for instance, our GDP, overall GDP, as I said earlier on, in 2023 was $363 billion. For South Africa, again, it was $377 billion. That is why we recently heard that Nigeria is now no longer the biggest economy in Africa, but now the fourth. So the likes of South Africa has overtaken Nigeria in absolute terms by close to, I think, $13 billion. Now, but it's not just enough to assume that because South Africa has a higher GDP, then it then means that the economy is doing better than the Nigerian economy. That would be a wrong way of looking at it. The only way you can decide whether the GDP of a country is impacting on the lives of its citizens is by looking at the GDP per capita. So how much is each person getting from the overall output theoretically? So if you do that for Nigeria, you come up with $2,460. That is what Nigeria's GDP per capita as of 2023 comes to. But in South Africa, the GDP per capita is $6,000. Now, if you go to advanced economies like the US, the European Union, it's even much more higher than this. The US GDP per capita is $65,000. In the European Union is about $37,000. Again, this explains why a lot of people are leaving Nigeria for these countries with better GDP per capita. So now you start to wonder, what exactly is the problem? How come Nigeria is not measuring up with the rest of the world? So if you look at, in terms of GDP, the size of our GDP, the GDP per capita, the GDP growth rate, Nigeria is not measuring up in any of this. And by the way, the average GDP per capita for the whole world is about $13,000. So with Nigeria at 2,000, it's a far cry from where we should be. Now, and this brings us to the GDP growth rate. At what rate is your economy growing? So if your GDP is $363 billion, I mean, the size of the Nigerian economy as a whole is barely the size of one Fortune 500 company in the US. So we are still a very far, we are still way far from where we should be as a country. The central bank recently said that it has the ambition to take our GDP to $1 trillion economy. So how can we actualize that? How can Nigeria economy go from $363 billion to $1 trillion? I mean, the US, for instance, has a GDP of about $27 trillion. So I'm not even speaking of Nigerian economy catching up with the US economy. I'm saying, how do we close some of this gap? And this is where GDP growth rate is important. So if you want to close the gap between yourself and these more advanced countries, and then improve your GDP overall, the overall output of the economy, and also improve your per capita, GDP per capita, then you need to be growing at a very, very fast pace. So in recent times, Nigerian GDP growth rate has really declined. The recent number we saw was 3.19%. So for a developing country like Nigeria, we need to be growing at a much more faster pace. So while you can argue that our GDP has improved from 1960 to 2003, the growth rate is extremely slow. This is the major problem with the economy. This is why people often say, hey, you guys are, as economists, people are saying the GDP is growing. We have a $363 billion economy. How does this affect the common man? This is the reason. The pace at which our GDP is growing is not matching population growth, and then it's not really inclusive. We're not achieving that inclusive growth that we want to see that affects everybody, because the economy is growing at a much more slower pace. Now, the question is, how can you get the Nigerian economy to start to grow at the sort of pace that will improve the standard of living? Because ultimately, that is what GDP should, a healthy gross domestic product should achieve. Better standard of living, better revenue for the economy, for the government, and of course, a lot of jobs, good jobs for everyone. So these are the things that, if your GDP is growing at a healthy pace, you achieve, and then it's going to reduce almost all of the issues that we're seeing. So if you look at Nigeria, almost every issue we are facing, whether it's banditry, whether it's exchange rate crisis, the Naira has really been on the downward swing lately. So all of this ties back to the fact that the economy is actually not producing. This is the crux of the matter. The economy is not producing. And we can get the economy back to production if the government would focus on specific things like infrastructure. By infrastructure, I'm speaking of electricity, water, road network, and of course, security. These are the core reasons why we've been seeing a contraction of the Nigerian economy, so to speak. The last time we saw GDP up to 6% was in 2014. Since 2015, we've been in and out of recession, and then the economy goes up to 3% and then goes down to 1%. This has been the story for the last 10 years. You can't achieve a healthy economic growth at these levels. Things have to change. And then, of course, investment in education, healthcare. These things don't always appear as if it has significant impact. But if you have people always in the hospital and not getting treated, productivity will decline. Work hours will go down. So healthcare is also important. And then education. If you're not investing in research and development, how are you going to catch up with the rest of the world? Because today, productivity is driven by technology. And technology is driven by investment in research and development. Okay, and then to the current GDP figure that we got last week, Q2 2024, the Nigerian GDP went up by 3.19%. Now, there is an important point I want to bring out here, and it's that oil, which we all focus on, contributes only accounts for just 5.7% of our GDP currently. Just 5.7%. And then the non-oil sector, which we often ignore, accounts for 94.3% of the GDP. So why, and this is the anomaly, why focus on a sector that accounts for just 5.7% of the GDP and largely treat the other sectors as an afterthought when this other sector accounts for 94.3% of your GDP. Now look at it. The oil sector grew by 10.15%. 10.15%. And the overall GDP still was at 3.19%. So if it was the non-oil sector that grew at 10.15%, I'm sure I would have gotten a GDP number that would be close to 8-9%. Yeah. So I think we need to accepted that the oil sector is the most important. It's like a free lunch for us, like a free lunch. But you don't have to get hung up on this free lunch. It's a lunch you can take and improve other sectors. So for Nigeria, I think we should be treating oil as a low-hanging fruit. Speaking of looking at the UAE experience where they took oil and transformed other sectors of the economy. This is the path that I believe Nigeria should be towing if we hope to achieve a stronger and a more stable growth in our GDP. 3.19% is to me is no growth for a developing country. 3.19 is no growth. Again, we can argue that is an improvement from the first quarter of 2024, also an improvement from 2023. But it's an improvement, but it's not something to be excited about. It's not something to be excited about. So I don't know how we're going to turn this around as a country. I don't know what needs to happen. I just don't know what needs to happen. I don't know the sort of policy direction that we need to implement. Maybe if we get, and really thinking about it, we had the glorious year, the era where we had Lamido Sanusi as the central bank governor, and then Okonjo-Iweala as the Minister for Finance. So it makes me think that if we get, I really wish we could get another run with that pair, but in a different role. Like Sanusi was the charismatic guy who was very, like he was an activist kind of central bank governor. I think we need somebody like that as Minister of Finance, because a lot needs to happen with fiscal policies. So if we could get somebody like Sanusi Lamido as Minister for Finance, again, I'm not saying the current Minister for Finance is nothing casting an aspersion as to his capabilities and his potentials. No, that is not what I'm saying. Yeah, but I'm just assuming. We may never get this wish. It may not happen. But we need, the point I'm making is that we need a Minister for Finance who is radical. Someone who can put his life on the line to get some things changed. And then we also need a central bank governor who is conservative, somebody who you are not going to push around, who is going to play by the rules, who is going to concentrate on doing it the right way. Nigeria just needs something to change for us to get to where we are, where we should be as a country. Now, as an investor, how do you digest this information? How do you look at the numbers? The current GDP is at 3.19%. Oil sector grew by 10.15%. Services, talking of ICT and banking, accounted for 59% of the GDP and grew by 3.79%. That is massive. Again, I feel like manufacturing should be accounting for a greater percentage of our GDP. Manufacturing, agriculture, and industries should account for more of our GDP than it currently accounts for. That needs to happen. So as an investor, those are the things I'm looking at. I want to see stronger contribution from manufacturing, from agriculture, and then, of course, investing in a country like Nigeria, you want to see the GDP at a level between at least 6%, 6, 7, 8, 9%. It needs to be at that level. Otherwise, what you see is that even if you are invested in a business that is growing at, say, 20%, 30%, ultimately, that business will be pulled down to the level of the GDP in the long run. If there is no improvement, you're going to pull down even these firms that are growing at a higher pace. You're going to pull them down to the level of the GDP. So I want to see a stronger growth in our GDP. I'm looking at the long term. As an investor, I want to see what happens, not just today, but what happens 10 years from now. Those are the things that inspires confidence in the market. Otherwise, investors have the options to move their money elsewhere. Capital is mobile. Investors have the option to move their funds to where the growth rate is better, the growth rate is stronger and more sustainable, just to guarantee or get confidence that you're going to get the sort of return that you require in the long run. So to the US market, last week we saw the S&P 500 improved slightly by 0.24%. The Nasdaq declined by 0.92%. And then the Dow Jones went up by 0.94%. So ultimately, the only index that declined of the three major indexes, the only one that declined was the Nasdaq. And a lot of that had to do with NVIDIA reporting last week. On the show, the previous episode, on the 5th episode, I did say that I was looking forward to last week because NVIDIA was reporting, and it's one of the most, if not the most important earnings report that the market wants to see. So that report came out, and then the market wasn't very excited about it. I will come to that later on. But last week also, we saw the personal consumption expenditure. That is a metric that is favored by the US Fed in estimating inflation. That figure came to 2.6%. So it points that inflation is going down. It's trending in the direction that the Fed wants it. If you listen to the Fed chair's remark 2 weeks ago, he did say that it's all but certain that they'll cut rate, but they want to see what the numbers comes to, the economic variables. They want to see that it's trending in the direction that they want. And this is one of those variables that I'm sure they'll be looking at. So it kind of solidifies the notion that we are guaranteed to get a rate cut come we're in September already. Later this month, we're guaranteed to see a rate cut by the US Fed. And then, of course, you wonder how all of this factors into the September effect. There's the historical trend where most Septembers we see a decline in the stock market. Speaking of the US stock market, are we going to see a September effect this year? With all that is happening, personally, I doubt if we see that happening this month. I really doubt that. You look at the VIX, the volatility index. It's close to a 5-year low. I think 15 point something percent, about less than 16% currently, the VIX level, which tells you the level of volatility in the market. So I really don't see the market tanking this month when you account for all that is going on and the fact that it's more than likely that the Fed will cut rates. Maybe if the Fed fails to cut rate at all, that could spook the market and send it lower for September. But otherwise, I don't see a scenario where we see a decline in the stock market for this month of September, all things being equal. So I would move on to the reports from NVIDIA. We saw a 122% growth in sales. In terms of estimates, revenue beat estimates by 4.16%. Earnings per share beat estimate by 6.25%. But as we've come to see, what the market was looking for was not actually the performance of NVIDIA in the second quarter. It was more about the guidance. I think the market has gotten very used to NVIDIA outperforming estimates. I can't remember the last time NVIDIA performed below estimates. So the market has kind of gotten very used to that and has very high expectations every quarter from NVIDIA. So what the market was actually doing was looking forward to say, what are you going to do this quarter, Q3, the third quarter? What are you going to give us? I think the market wanted to see what NVIDIA was going to do with Blackwell, the next generation of advanced chips. We've seen months and months of delay in the release of Blackwell. And it doesn't look as if that advanced chip, the next generation of NVIDIA's chips, will hit the market until maybe Q4 this year. So I don't think the market took that very well. By the way, NVIDIA also has a chip currently selling to its customer. I think it's Hooper, the current chip NVIDIA has in the market. So the market is saying, can Hooper sustain your demand for this third quarter? So we saw that decline in the share price, almost 6%. I think on the day the result was released, the share price tanked by 7%, and then we saw some recoveries for the rest of the week. But as an investor, these are the sort of opportunities you are looking out for. It's always about identifying companies that you like, and then looking for opportunities like this when there's a pullback to either average down your price or look for attractive entry points as an investor. So ultimately for me, you have to ask yourself whether you're an investor or a trader. If you're a trader, then you're going to go by your trading rules. Are you going to sell if there's a decline of more than 10%? Well, I don't have so much to say there. But as an investor, you're looking for opportunities like this to either average down or find attractive entry points. So NVIDIA continues to lead the race in terms of the advanced chips it has and the network and the client base that the company has amassed over these years. They stayed ready and they are reaping the benefits of artificial intelligence. So I think NVIDIA still has a runway of, say, 2 to 3 years in my estimation. And eventually Blackwell will hit the market, and then we'll see how that performs going forward. But ultimately, this result was impressive, and I think NVIDIA will continue to outperform expectations in the coming quarter. Then to CrowdStrike. CrowdStrike was another company that released its Q2 earning report last week. They also beat expectation. EPS, they beat EPS by 7.2%, beat revenue expectation by 0.63%. The revenue year on year grew by 32%. Again, for CrowdStrike, it was all about expectations. What expectations, what projection what guidance did the firm provide for the next quarter? And that guidance was not very impressive. However, the share price went up by over 4% for last week, despite CrowdStrike not providing a strong guidance for the next quarter. Ultimately, I guess the market is accounting for the fact that it already expected that the earnings will not be as strong as it's been due to the global IT outage that we experienced last 2 months, I believe. I think 2 months ago, they had this outage that impacted a lot of companies, some of which have even threatened to sue CrowdStrike, like Delta Airline has threatened to sue them. So ultimately, we expect those to impact their earnings in the short term. But how they recover from this is, the report wasn't as was impressive when you consider all of what has happened the last couple of months. This result was impressive, but how they and their customers respond to the outage is what we will see play out going forward. But still a very impressive company. Year to date, they have not performed very well. The stock is down year to date, despite all that has happened, by 8.64%. So we'll see what happens going forward. But not a bad performance for a company that lost, I think, close to 50% of its value because of the global IT outage a couple of months back. So it's to be seen what happens with this company going forward. And then to another interesting story from last week, Berkshire Hathaway achieved the capitalization of $1 trillion. Berkshire became the first non-IT firm to join the likes of NVIDIA, Microsoft, Amazon, Apple, to reach a capitalization of $1 trillion. And there's a lot of lessons to learn from this. Berkshire Hathaway was incorporated in 1839 as a textile company. And around 1965, the company was struggling when Warren Buffett took over the company, a textile company, and then transformed it from a textile company to a conglomerate that now has investment in diverse businesses from railroad to insurance to technology. Their investment portfolio had Apple Apple accounted for almost 50% of their investment portfolio. They also had banking stocks like Bank of America and a couple of firms, Coca-Cola, PepsiCo, Kraft and Heinz. All of those companies they have in their portfolio. So Warren Buffett practically transformed this company from a textile company to a global conglomerate. And again, there are a lot of lessons one has to learn from this company hitting the level of growth that we have seen over the years. And it's all about value investing. Warren Buffett is a known adherer to Benjamin Graham's philosophy of value investing. Value investing, I think it's something that most people confuse with investing in penny stocks. I've heard a couple of people say Warren Buffett invests in penny stocks. No, he doesn't invest in penny stocks. He is a value investor. And what that means is that he will go out looking for companies that are trading at prices cheaper than their intrinsic value. So it's like saying, I have this phone. What is the value of this phone in the market today? The value is, say, 500,000. Now, I'm going to start looking for where I can find this phone to buy at 300,000. That's going to require patience. That's going to require a situation where a lot of people don't believe that this phone is actually worth 500,000. And then I say, hey, and then the value goes down. Then at that point, I'm going to buy it. So you have a situation where there is panic, maybe there is war, and people are not ready to buy phones at 500,000. So in such situation, you're going to see the price come down to 300,000. So value investing requires a lot of discipline, requires a lot of patience. So it's not just about going to the market and looking for stocks that are trading at $1 or $1 or 50 cents. No. And then while doing that, you're also looking out for margin of safety. So you want to be sure that you are buying at a price that is much more lower than the intrinsic value. So you give yourself that allowance that even if things don't go as planned, even if it doesn't pan out as you expect, you have that allowance to minimize the level of risk exposure that you have making such investment. And of course, long-term investing. He's always been a long-term investor. And then again, the idea of investing for the long term, that has been one cardinal point of his investment philosophy, having a long-term outlook to investing. Now, if you had invested $1,000 in Berkshire Hathaway in 1965, that 1,000 will be at least $40 million today. Sounds impressive, right? Because since 1965, on the average, the company has returned 20% annually, compared to about 10% for the S&P 500. This figure is impressive, but it's not as easy as it sounds. Between 1965 and today, there were years where the company lost close to 50%. We had stretches of years where the performance was negative. So as an investor, would you have stayed? That would be the question. If you had invested $1,000 in 1965 and then 3 years later you're seeing that your investment had lost 50%, would you have stayed? And this is where investing is difficult. Most people will say, I'm a long-term investor. But when the chips are down, would you stick to that? This is where investing is very difficult because most people will sell and bolt. Like most people can't bear to see their portfolio negative for a year or two. Most people can't bear that, But if you find a company that you like, I think long-term investing actually says that you stick around with that company for as long as possible, because ultimately fortunes are going to reverse. And this plays out in the market every day. You have noise in the market, you have companies that are losing 40% for one reason or the other, and you have guys that are selling. So my question is always, who are you? Are you an investor or a trader? If you're an investor, then you need to ask yourself, what is going on? Is it going to affect the long-term prospect of this firm? If it won't, then you stay. If you're a trader, then you go by your trading rule. If your trading rule says sell, you sell. So I think it's important for us to always make that distinction between who we are in the market, whether you're a trader or an investor. And then also, I feel like the success of Berkshire also emphasizes the point that you can be successful investing without being woke. By woke, I mean today a lot of people just want to invest with the trend. You have meme investors, guys who want to invest in cryptocurrencies, guys who want to pretend as if they are traders in the market, buy high, sell low, and all of those things. You can be successful without doing any of this. In fact, I think that when it comes to investing, boring is better. And Warren Buffett once said that if you want excitement, take $800 and go to Las Vegas, go to the casino. That's where you get excitement. If you want excitement from the stock market, you may lose money, or from investing. I think boring is better. And boring means staying true to fundamentals, staying true to tried and trusted principles for as long as possible. So that's another valid lesson that one can pick from this story. So if you look at the sort of companies that the investment portfolio of Berkshire Hathaway, you don't see too many exciting names. Apart from Apple, of course, you have Moody Corporation, Kraft and Heinz, Occidental Petroleum, which started buying very recently, Chevron Corporation, Coca-Cola, American Express, Bank of America. These are the sort of companies that have helped them become successful over this long period of time. So you just don't have to do anything exciting. I'm not saying these names I've called are not investment recommendation. You can find your own lineup and stick to it if you really believe in them, and not just stick to it for a while, but stick to it for the long haul. And then over to the Nigerian market. If you've listened to me the past couple of months, I've been saying it repeatedly that the level of interest rates we've been seeing the last couple of months is the highest we've seen in the history of the country. They were historical highs, and that such level of interest rate is not sustainable. You can't have interest rate at those levels forever. And then last week, on the 5th episode, I did say that it appeared that interest rates had peaked at just slightly over 20%. But from Monday, we saw those rates start to come down. Currently, you can't find 20% in the bond market anymore. Maybe treasury bill yields, you can still get up to 20%, but in the bond market, yields had come down to 19% level in the mid-tenured bonds, 2033, 2034. Same with the short end of the bond market, the 2025s, 2027s, 29s. We still have rates at around 19%. And I think I would expect those rates to still come down for the rest of the week. The long end is even much lower than this. If you look at the 2053s, 2051s, rates are around 16, 17%. So it goes back to what I've been saying all along, that if your investment objective is long-term, you need to consider extending the duration of your portfolio, which means moving away from short-term market, like the treasury bill market, to the longer end of the market, that's the bond market. So this is playing out already, and we need to all account for it as we make our decisions, our investment decisions for the week. For the stock market, we saw a gain last week by 0.63%, and it was primarily driven by Owando. Owando has been trending the past couple of months. Last week it was up about 55%, and this week again is up 60%. In the last 1 year, that will be over 800% gain for Owando. I don't know if the recent acquisition of the Nigerian Ajib oil company, I don't know if that is enough to account for this rapid growth in the fortunes of Owando. But it's what it is. Is this sustainable? Should you be buying Owando at these levels? I absolutely have no idea whether you should be doing that. This is kind of massive, the level of growth we've seen in the share price of Owando. For the insurance sector, it went up by 5.76%. Consumer goods 3.4%. So good week for the Nigerian stock market. And again, if rates continue to trend downwards, then we may start to see increased interest in the stock market again if rates continue to decelerate. It's a new week, and I'm looking forward to see what happens this week. But certainly, I'll be back here on Monday to run you through events and what happens in the market this week. Until then, stay blessed. I'm Nathan, signing out. And don't forget to subscribe. Thank you.